Bless you guys. Welcome to the follow-up session of the Bitwave Digital Asset Maturity Model webinar series. Today we have a fun one. So last week was how do you survive with digital assets, and this week we're looking at how are you going to thrive. So this is the next step in the process, moving from the oh crap, our CTO did something crazy moment to like, hey, we're a digital asset enabled business and we're going to get serious about this stuff. So that's what we're going to be talking about today. Should be a lot of fun. Looking forward to all of this. Really briefly, we're going to do a quick overview of kind of where we are right now. I always like, we're doing these every 3 weeks, and it's kind of fun to talk about the latest happenings within the crypto space. So we'll do a really quick intro to like what's happening right now, and then we'll go through kind of the steps that we define as part of the digital asset maturity model and all that piece. And then finally, we'll get to how can you thrive and actually, really take advantage of what's happening with digital assets as a business here. My name is Pat White. I'm the CEO of Bitwave. Bitwave, we're the market leading tax and accounting solution for businesses that use digital assets. What you'll see as we get into this more, Bitwave provides a lot more than just tax and accounting, all back office, AR, AP, all that kind of stuff. A lot of that will be very relevant today because we're talking a lot about those more complicated processes. Like we're moving out of the realm of like, hey, how do I just do tax and accounting for crypto, into like, hey, we have very, very complex processes that we need to be able to run. How do we handle those? We have over 70 customers, bumping up almost to 100, and we're backed by some of the leading investors in the crypto space. If you haven't watched it already, go to YouTube. We've got the previous webinar from last week. There's some stuff that is relevant to this. So if you go back to last week, there's some stuff that will be relevant to the webinar today. We won't spend a lot of time recapping it, but we will try to go over it just a little bit. So you can always pop back to that. And I've always wanted to say this, smash that subscribe button, and you too can get up-to-date videos about crypto tax and accounting. I've never gotten to say that before. That was the best day of my life. All right. So before we get started, we are going to do a really, really quick poll. And I think this is super fun because between when our last webinar was and today, we had Thanksgiving in the States. And the current poll is, did you talk about cryptocurrency with your family, with your significant others, with your friends, with whoever you happen to see around Thanksgiving? Did you talk about cryptocurrencies during Thanksgiving? I'm so curious. Like, this got to be like 100%. Like, this is my official guess on this is that we are running at a strong 100% on this. But let's see. All right, we'll give you 30 seconds to take the poll here. 1,000, 2. I know it came up a lot. So both with my family, there's that great meme of like everyone looking at the kid in the attic, like asking like, how is your magic internet money doing? But then also a lot of my friends being like, we do a Friendsgiving and everyone wanted to talk about digital assets. Yeah, so 90% people said yes. That's awesome. Oh, dude, I love it. That's so much fun. Yeah, everyone wanted to talk about it. I mean, a lot of it was funny stuff like, Pat, what is Dogecoin and why is that a thing? But we'll kind of get into that later. So what's going on? What's happened since the last time we all spoke here? Crypto.com. This is a big deal. This one is funny because I mean, there's two. There's the Staples Center, which is the Crypto.com arena, and then there's the Miami, the stadium in Miami. That's the FTX Center. So the massive influx of money from crypto companies doing advertising. If you watch F1, which like I like to watch F1, every single car has something from crypto. So like the Mercedes car has FTX, the Red Bull car has Tezos on it. Like crypto, the money around crypto here that's swarming into this is like spectacular. This is a pretty big deal. I mean, Staples, getting replaced with Crypto.com. I guess it makes sense. I mean, I haven't been to a Staples in like a good decade, whereas I buy crypto all the time. So I don't know. This makes sense to me. We wanted to spend just a little bit of time. Well, let me talk about this one really quickly. Bitcoin was down, had a huge dip. We had like basically a across the board market crash over the weekend. The reason I wanted to mention this is not because it's sad. Like we're all, everyone here has kind of been crypto for the long term, so we tend to be sort of used to it. But it's one of the things that's worth mentioning in terms of this webinar in particular. So like last week, the idea was, and we'll talk about how the maturity model addresses different stages. the maturity model last week was, you have an immaterial amount of digital assets on your balance sheet. The maturity model for the next webinar we're going to do is like, hey, you're a crypto pro. How do you really start taking advantage of it? This week is about scaling your efforts. It's going from like, $100 of crypto to a few $1,000,000 of crypto. And it's crossing that threshold of materiality from an accounting perspective. It's where you go from immaterial to heavily material is part of this process here. And so one of the things that is relevant there is that suddenly you are holding an asset that can swing $20,000 or $15,000 in a day. That's not normal. A 20% drop in one day for most of the assets that your company would handle is not normal. So part of the things that you need to be thinking about, there's what we're going to be talking about a lot today is processes, accounting processes, all these different things that go into that kind of side of it. The other thing, which we're not going to spend quite as much time talking about, but it is still very relevant, are risk processes. Like, you probably don't want to take your entire corporate treasury and put it into Bitcoin. You probably want to think about how you spread it around, how you look at it more holistically. And this is one of the reasons, is that Bitcoin still is a volatile asset that you need to kind of, you need to think a little bit differently about. And so treasury management in this world can mean having some exposure to crypto, to Ethereum and Bitcoin and those types of coins, but then also keeping a lot of your assets in USDC and earning yields on them. So these are the things to kind of think about as you move into this step of the maturity model. We're going to show this at every one of the rest of the webinars, but I'm going to pick like 2 or 3 things to talk about here, just because it's kind of fun and what the hell else should we talk about? The words that we're going to define today are aped, because I love the word aped. This is kind of like, there's this like tight integration between Wall Street bets and like the crypto community and all this stuff. And so this idea of aping into something it's just like YOLOing, or it's basically like getting into something without necessarily a lot of due diligence, I think, and going in with perhaps a larger allocation of your portfolio than you might normally want to expose yourself to. So if you hear someone that says, hey, I aped into something, it's like, it all comes from the movie Planet of the Apes, where they're like, apes together are stronger. This is this idea that like, groups of random internet strangers can move markets by getting in together into these markets. So that's a fun one. Meme coins is a great one to think about. So there are a lot of coins that are popping up these days that have absolutely no use, no purpose, should not exist. And the only thing notable about them is their funny name. So like Doge is kind of the original meme coin. Shiba is the next meme coin. There's like a billion other ones. There's like Shiba Ninja, Doge Shiba, Shiba Doge, like every single thing. These are coins that are based on like funny images and funny pictures. And really, they're not necessarily changing the narrative around blockchain. They're really just put out there as a pure, it's just the way I like to think about these coins is that it's kind of like a global game theory game, because essentially there's a run up and a crash. And so there's essentially, it's this amazing game of brinksmanship where like a bunch of people pile into a coin and everyone waits. And then at some point, everyone starts getting out, and it's kind of like it's sort of a pump and dump, but like everyone kind of knows it's a pump and dump. So it's almost like more of a game of brinksmanship. Like it's this like really interesting game that like a lot of people play to kind of steal money from each other and these weird sort of game theory mechanics. The last one I'll talk about is the flippening, because the flippening is actually a really relevant today, because what we saw the last week is we saw Bitcoin go from 65K to 47, actually hit 42 on a couple of exchanges. And we saw Ethereum essentially stay pretty solid. The flipping in is this idea that's been happening for a while, and it's used to kind of describe a lot of different stuff out there. But the main one that was used to be used for was for when economies would flip from fiat to crypto assets. So there is this high level theory that at some point, the U.S. economy might flip from the U.S. dollar to Bitcoin. It's never really going to happen, but that was like the original theory here. Where you do see that happen is places like Nigeria and Venezuela, where you have hyperinflation. So we have hyperinflation. You've seen a flippening from like the local currency to USD. The theory here is that you're going to see a flippening from the local currency to crypto assets. More recently, this is also referring to when the market caps for Ethereum and Bitcoin are going to flip, or if they're going to flip. It's an open question. Who knows what's going to happen? Right now, Bitcoin is a 60% market cap of the overall crypto market. But last week, that took a huge hit. I mean, I think it was a 10% swing between between Bitcoin and Ethereum. So the question here, when you hear people talking about the flippening, they're probably talking about this idea is like, is Ethereum going to become more valuable in terms of total market cap than Bitcoin? And it's a super interesting question. And it's an interesting way to think about the world, because Bitcoin is a store of value. It'll always have a lot of value. Ethereum is a network for use. It's a network to be used and be poked every day, and to actually like have people using it on a day-to-day basis. These are very diametrically different things. It's basically comparing like the market cap of gold to the market cap of Microsoft. They're orthogonal but comparable, and that's what the flippening is sort of questioning. All right, let's get into it. So where we were last week is we were in the adopt phase. Your CTO bought a bunch of crazy stuff. We're now sitting on we as a business are now sitting on a couple hundred Ethereum. And this phase, the next phase here, which is the expand phase, which we're talking about today, is like, we're starting to actually do more with it. It's becoming more of our process. We're starting to get paid in crypto. We're starting to pay our employees in crypto. We maybe have 1 or 2 revenue streams that depend on crypto. Maybe we're doing some smart contract based stuff. Maybe we're doing some staking or some mining. The adopt phase is about like, okay, oh crap, let's get our feet underneath us. The expand phase is like, hey, now we're going to go from 100 transactions and 1 person using it to 1 million transactions and 100 people using it. And how do we actually structure ourselves for that? After phase 1, the things that you would have accomplished. So this is, if you guys want to go and watch the previous webinar, this is some of the stuff we talked about. First of all, you have a tiger team. So this is a wonderful corporate malarkey kind of word, but basically you've identified people who are your corporate, your cryptocurrency people. They're going to be a combination of tax people, because remember, every crypto transaction is both an accountable transaction and a taxable transaction. So you will have accounting people, you will have tax people, you may or may not have compliance people, you'll have some operations people who are thinking about operation side. You're going to want to have like 4 or 5 people from across the organization, maybe even a product person in there, who are all thinking about how digital assets are going to change your business, how you're going to account for them, how you're going to do taxes, how you're going to keep them secure, how you're going to make money from them in the long term, how they're going to impact your business. This is the tiger team, and you've gone through a little bit of training with them. Second, you've started to adopt some sort of scalable process around your digital fintech. This might be something like Bitwave, it might be spreadsheets, it doesn't really matter at this point, but you have some sort of repeatable process so that you can close your books. Not necessarily quickly, but you can close your books. And then finally, you've kind of modified you've defined the day-to-day processes here. And this is a really important one, which is like you've begun to say like, okay, when we spend this, here's how we account for it. And this isn't just saying we have like a general spreadsheet. This is saying we know how we're going to download the transactions on the blockchain. We know what we're going to follow. Like, are we going to impair this? Are we going to be doing GAAP? You've actually addressed these questions with the people that matter. You've thought about, are you going to be commingling funds in wallets or keeping them separate? Like, you've started to establish some of these processes at this point. This model now is, you've gone from sort of like inconsistent processes and sort of like some kind of rough skeleton. This process is all about scaling. Level 2 is getting to scale. It is building in the repeatable processes that actually enable you to go from the way I like to think about this is that you are essentially going to go from about 100 transactions a month to maybe a couple or maybe 1,000 transactions a month to very, very, very quickly, you're going to be getting over 1,000, 2,000, 10,000, 100,000 transactions. Like, crypto has this thing. Crypto has this gravity. It has this like black hole type effect, which is you kind of can start very small, but it is not at all surprising when like a month later, you're suddenly doing thousands of transactions or, tens of thousands of trades, or you have an arbitrage bot running and making, 100 blockchain transactions a year, a month. There is this thing where it's like, once you can start programming money, it is no longer like, I need to call my bank to make a wire. It is like, I can write a bot that will make 1 million wires a minute. Now what do I do? And so what tends to happen is if you are really adopting digital assets as a business and you're actually building them into your business processes, you will start to see the transaction volume go up drastically. You will start to see the number of people at your organization who have access to digital assets in terms of petty cash wallets or kind of custodial wallets or exchanges, trading desks. Like you will start to see that go up very, very, very quickly. And you have to be kind of ready for those processes. And so the level 2 here is all about how do you scale this? How do we kind of like really set up processes to scale our digital asset tax accounting and compliance and kind of treasury management pieces here. This stage is very, very notable on this graph. We showed this graph last time. I love this graph because it basically is showing like, you know, there is this lagging thing that is happening, is that as you are adopting digital assets, your risk is going up, but your opportunity is also going up. And so as you know, what you want is you want those two to eventually meet where your opportunity and risk are at the top, or even like your risk starts to go down because you have such a great grasp on it. Level 2 is arguably the most dangerous level here because it's before you've necessarily started doing a lot of things that you are taking advantage. Like it's before you necessarily have big revenue streams from digital assets. It's before you have, you know, NFTs from your intellectual property. It's before a lot of the things that really are maximizing opportunities, before you're doing DeFi. But it's where you have exposure and you have these risks where you have to, like, you have a lot of assets, you have a lot of transactions, you have a lot of exposure to digital assets, and you have exposure to people losing their private keys and all of that kind of stuff. But you haven't necessarily hit the upswing of the opportunity curve yet. So this is one of the most dangerous parts of this entire journey where like you're still learning, and the odds at this point are that you lose a private key because you're still learning. And so this is the highest level of risk with kind of the lowest opportunity. So it's a state to be very, very conscious of and to really watch very carefully in terms of your processes you're developing and what we're all kind of going through here. All right. So given this stage, here's our next poll. Given the stages we were just looking at, which is kind of going from, you know, level 1, which is like, oh my God, we just got a little bit of crypto. Level 2, which is, hey, we actually are starting to build processes, and then beyond. You know, where are you as a business today on this? Level 3 would be you're actually starting to really monetize crypto. You're doing stuff that's built into your business processes. Level 4 is you're using DeFi. And that's like, I kind of think of that as like the highest level for businesses where like your treasury is starting to move to DeFi. You're starting to actually do stuff in DeFi here. What's our hypothesis here? I would say my hypothesis here is that most people are around level 1 or level 2 with kind of a handful out at the further fringes of this, but we'll kind of see where this comes in here now. Yeah, this is a super interesting question. And of course, we haven't done full definitional stuff on level 3 and level 4 yet. Those will be the next webinars. But you know, like, yeah, it's level 4 is DeFi. Level 3 is like we have smart contracts and NFTs and all that stuff. All right, let's see here. Pretty evenly spread. So a lot of people brand new, one person brand new, people spread across the entire thing. Good numbers here on people who are using DeFi and at that real high level maturity. That's what I like to hear. That's awesome. Great. All right. So let's start talking. Let's actually drill into this a little bit. How are we going to start thriving with digital assets? How are we really going to start scaling this? The definitional pieces here, and I went over them a little bit, but I'll just mention them again. You went from having like 1 or 2 wallets, 1 or 2 assets, one person who has access to the wallets. At this level, that begins to change. Your assets start to go up dramatically. Most of our customers hold between 10 and 20 different types of digital assets. We have very, very few customers that are like purely on one asset or another asset. Most of them have quite a few more. So most of our customers have above 10 to 20, wallets as well. So like you're starting to see a massive growth in number of wallets. It's not just one wallet where you can go to Etherscan and download CSVs anymore. You now have a lot of wallets. It's not just 1 or 2 assets where you can do pricing on a day-by-day basis manually. You have 10 or 20 assets. And it's not just one person. It's not just like one throat to choke. When you have one person doing all the digital asset stuff for your company, when you see a transaction on the blockchain that you don't know what it is, you just Slack them. You're like, yo, Bobby, what was this 3,000 USDC you sent out? At this point, you start moving away from that because you have more people with more wallets that actually are able to spend digital assets. and you now have more than one throat to choke, and that makes choking throats that much harder. So it's straining the analogy, pretty extremely straining the analogy here. But the more people you have spending digital assets, the harder it is for, like, the more diluted your ability to kind of track an individual transaction is. So the more you need to have processes and systems in place and all that kind of stuff. You might have people in your company transacting in crypto. So, at this level, they might be actually buying things in crypto. They might be earning money in crypto. Like, we get paid, Bitwave gets paid in crypto. We pay some of our vendors in crypto. At this stage, it's not just a crazy experiment your CTO is doing where he has a little bit of Ethereum. Like, it is becoming a real part of your business, and you are expected, in the same way that you're expected to be able to satisfy an invoice in Net 15, like, you're expected to be able to turn around a digital asset payment in Net 15. And they don't care that your CEO is the only person who has access to private keys and he's on paternity leave, or like that stuff that stops the matter, because your ARAP processes can't stop because a single individual is not available. So you need to start thinking about, like, how do you start to distribute the responsibility for digital assets? How do you start to set up petty cash wallets so that the things that would traditionally be done out of, like, something like Bill.com can be done out of by your bookkeeping and finance team. Because that's essentially, in order to do a Net 15, you can't rely on the goodwill of your CTO to have time to send a transaction, or 20 or 60 or 100. I mean, it's not uncommon. Like, our customers are doing 60, 100, 200 crypto transactions a month. At that level, asking your CTO to spend 12 hours, which it theoretically could be. I mean, it really depends, but, like, asking your CTO to spend 12 hours, like, in their MetaMask, like, click, look up price, click, look up price, look up address, look up price, click, like, doing that it's just not going to happen. And so you have to start thinking about, like, how do you start to distribute that responsibility around your organization more? How do you start to have more people that can spend, but tighter controls on that spending? Once you have that, how do you monitor it? How do you make sure that, you're I was on a call with someone who was like, out her back window yesterday was all snow, and I'm like, well, what if like that person's like, what, screw this, and decides to go somewhere warm. You need to be monitoring the assets in the same way you would monitor your bank accounts or your credit cards. You need to be monitoring your crypto assets for fraud and shrinkage and all the normal stuff, and building up ARAP process. And of course, like, having systems. Like, at this point, you're moving out of where you can kind of do this manually. You're moving out of the level where you can have manual downloads, moving out of the level where you can have, like, where you can just have someone kind of doing this manually on spreadsheets. When you get, I think spreadsheets tend to scale for the problems that we deal with here. Spreadsheets scale in one of two dimensions. And, like, when Bitwave, when we lose a deal to spreadsheets, I never feel bad about it, because, like, if you can use a spreadsheet, you should use a spreadsheet. You can either do a lot of transactions, or, like, a fair amount of transactions in one or two assets, or you can do a very small number of transactions, but in, like, a large number of assets. If you go on either side of that chart, so you think about, like, the chart is like few assets, lots of transactions, lots of transactions, few assets. If you go anywhere besides the two edges of that chart is where you really need to start using a system, because it's where you start to run into pricing issues, you start to run into all the other issues that you can imagine you start bumping into, and that's when you really need to have a system. So if you have, if you're just buying and holding Bitcoin, and you only have a few transactions and it's just Bitcoin, spreadsheets are great. If you have, like, 20 different assets, but you just transacted them once a year, then again, spreadsheets are fine. As soon as you hit any inflection between those two things, though, that's when you need to start looking at software to kind of solve these problems. So the roadblocks you're going to hit here is that as you start to scale this outside of your CTO's office, or, like, one person in your company's office, you will have a lot of people at your company who are not familiar with this stuff. And so the first thing you're going to run into is the lack of awareness. And there's a lot of people that have a lot of really difficult stuff to learn, right? Crypto is not easy. It is a paradigm shift. It is a different way of thinking about the world. That involves, like, even, like, slightly changing your philosophy on, like, fiat currency. There is a lot to teach a lot of people. And so as you are scaling this up, you will be continuously running into people who don't know about this stuff, who are just learning about it, who are getting into it, all that kind of stuff. The next roadblock is you're going to run into a lot of transactions. We talked about this at length. But due to that number of transactions, you're starting to hit bumps in kind of like the time it takes to manage this stuff. And so this is where, you were doing this on a spreadsheet, everything was working just fine. Suddenly it's taking an hour, 2 hours, 3 hours, 5 hours a week. And at that point, you're like, oh my God, I'm spending like more time on this than on any of my other kind of bookkeeping or accounting duties. Like we've hit that inflection point where it makes sense to go look for a vendor. Like the TCO has kind of flipped on this. The other roadblock here, which is not at all obvious, and I love talking about this, is like wallets and tokens multiply. A lot of people go into if there's one misconception that people have about digital assets, that if you ask a layperson about them, that I would say the one universal, probably the first one is like that it's just that like it has no value and that it means nothing, and that's fine. I mean that's a philosophical discussion. But the other one is like no one realizes how easy it is to create a wallet. Like you guys see on my screen, I have MetaMask here. I can create 20 wallets in literally 10 seconds. Like I can like click 3 times and create 20 wallets. People tend to come to digital assets thinking that creating a wallet is the same level of kind of difficulty as setting up an exchange account or a broker account or a custodian account or like any of the things that we have in a traditional world. Like in a traditional finance world, the things that you have to set up take a long time. Like if you are a big public company and you want to get open a bank account, you have to get the board to sign off on it. Like that is not a minor deal. Like that is a major, that's a major undertaking to open a bank account. Crypto is not like that. The crypto assets, they feel a lot more like bank accounts because you are fully liable for everything that happens in those accounts, but you can set them up with the speed and efficiency of at literally any rate you want. And so what you find at this stage is that the growth of wallets is starting to outkick your ability to kind of keep track of even what is happening. And so the processes we're going to talk about they're not just processes around like technology and things like that. You want to be setting up business processes in your business that says like, hey, Mr. CTO or developer manager, when you create a new wallet, you need to tell me about it. Otherwise, like there have to be like consequences and things like that. Like, and I will tell you, I had 2 different customers this week that found wallets from like 2020 worth over $1 million. And it's funny to think about this. A lot of people in traditional finance might hear that and be like, Pat, like, what are you talking about? That's absolutely insane. But you hear it literally all the time where someone's just like puttering around. You get a message like, I think one of the conversations was like, they were trying to figure out how to fund a new product. And one of the guys like, well, I have a wallet that has like $1 million on it. And everyone just like looks up like, dude, like, what do you mean? Like, we don't know about that. This is not uncommon. In fact, this is incredibly common. And the other side of that is common too. Like maybe you set up a little developer wallet with $10,000 on it. And then the next day, that wallet's something worth like $100,000. I mean, that is not at all uncommon in the crypto space. And so how you think like the wallet multiplication effect here is very real. It bites a lot of people. As they're going through this stage of maturity. And it's something that you want to start thinking about very early on on top of this. The last piece here is that crypto breaks your ARAP processes. There's really no other way to say this. Like we deal with this all the time. It's one of the features Bitwave has is full ARP. Like you kind of think you can do it, but at the end of the day, if you are either having to send out invoices with addresses, with crypto addresses, and then track as those get paid, or if you're doing bill payments and you have like a list of like 20 things you need to send out, you might think we've all become so reliant on like Bill.com and the process that they have, where it's all like one click to do all your invoicing and to like make money and send money and all that kind of stuff. Crypto, you might think it's there, but in fact, because it's more peer-to-peer, it ends up being a much more manual process. So, and again, getting back to that example of the CTO, there's no world where a CTO is approving invoice payments. But for a lot of companies that are coming off of stage 1 of the maturity process, there actually is. Like the CTO is the only person who might have access to your private keys of the organization. And so suddenly the CTO is doing payments for invoices that in a normal world would be a bookkeeping function by, even by an outsourced firm. And so that's an enormously different response. Like all of your traditional ARAP processes kind of break in a crypto world until you get through and actually start to redesign your processes for them. So So let's talk about what we're going to do. And then the right side of this we'll revisit as we kind of get into this, because this is what this is like what your goal is through all of this. So let's talk about how we go from early maturity to kind of the next piece here. So you already have your Tiger team. At this point, you've spent time kind of training them up. The goal here is really that as you're pulling together your Tiger team, you're kind of building a train the trainers model here, where they're becoming experts in digital assets. They're understanding the lingo. They maybe take my slide from before. They know what aping into something is, and they can kind of do the translation there. And so what you want to do is you want to move from kind of the model of like, okay, we have a few people at our company who kind of know about this stuff. You want to actually move into a real standardized organizational training process. So in the same way that you would do anti-harassment training, or you would do code of conduct training, or you would do IT security training, digital asset training is equally important. And it's important for all the same reasons of what we just talked about. I mean, like of those like 3 different other trainings, is that there's HR issues, there are finance issues, there is operational security issues in digital assets. All of those are real issues. A service that Bitwave provides, we do this for some of our customers, and it's a super fun day, is we actually do a training course where we'll come in, we will teach everyone how to create a wallet. We will explain to them what your seed phrase is. I imagine a lot of people that are on the call today, like they understand a lot of these words, but if you don't, I mean, we'll walk through like how to set up your seed phases. We will send everyone a little bit of like some digital asset. We'll find a chain that's really cheap that day, so we don't have to worry about like gas fees. We'll teach you how to go into a DeFi pool. We'll teach you how to make an online trade. We'll teach you how to like play a DApp or something, like some sort of DApp game, and then kind of close it all out. And then level 2 of that is then you go into Bitwave and actually account for it. This is something that you don't need Bitwave to do it. I mean, this is something that the Tiger team that you're building at your organization should start doing this everyone. And it's really important. I mean, the other thing to think about this is it's not just the people that should be doing this. Like when we created this training program because I wanted to train all of our salespeople up on digital assets. I mean, they know it pretty well. Like our salespeople know digital assets as well as anyone in the entire world, but like they can know it better. And so they should all do it. They should all have experience clicking the button that puts money into a liquidity pool and like feeling the nervousness when you're signing a transaction on the blockchain. And so this is something that you can do at your organization. Like, go and buy some Solana. Teach yourself how to go, make some DEX trades, go into some liquidity pools, and then buy a couple $100 of Solana. $200 of Solana is plenty of money to do a training for 50 people. I mean, honestly, you can Solana is so cheap to interact with. You can send out $5 of Solana to a bunch of people and basically make it all work from there. So set up regular trainings, train everyone, train your customer support people, train your engineers, train your CEO on it, train everyone who has to conceptualize or think about or do design work on digital assets. Start training them up on this stuff and build out those processes and include it as part of your onboarding. So when you do your onboarding training, include, hey, here's how you do a digital asset, transaction. Next, it's about developing processes. The way to think about this slide here in this part of the maturity model is that you need to get your close down to 10 days, right? I mean, this, like everyone who's in the crypto world, everyone who's in the accounting world wants to do a 7 to 10 day close. I say this on like December 7th. So we're all starting to bump into our like 10-day close here. You will need to have processes to do a 10-day close in crypto. It does not just happen. Like the world right now, even with tools like Bitwave, we will help a lot, but at the end of the day, your close is still a process. There is still things like you want to be doing validation. So essentially, like, you get a statement from your bank that you then rec your bank transactions in QuickBooks against. That is a very well understood process. Well, in the crypto world, you're getting a statement. You don't get a statement from any bank. And in fact, what is on chain is, if you think about what we've been talking about, you have 10, 20, 30 wallets on chain. So if you have 30 wallets on chain, there are 30 balances that I have to go and check in order to do my rec at the end of the process. That then starts to grow 10, 20, 30, 100, 200. Suddenly you have more wallets than you have time to kind of go and check it. So at that point, you need to start building, sampling. Like on a weekly basis, you want to pick 3 or 4 different wallets that you're going to go and sample to make sure that your local records, whether that be in a system like Bitwave or in a spreadsheet or whatever, you want to make sure that your local records are syncing up to what the blockchain says. But you have too many wallets to do that for every single wallet every single day. So now you have to sample. And then you have to sample transactions to make sure that what's getting into your general ledger matches what's in your Bitwave as a sub ledger, matches what's on the blockchain. And so you have to start thinking about these things. Crypto will naturally drag you towards some sort of automation process around digital assets, because the transaction volume starts going up and up and up and up, because it is so easy to do transactions that you will start naturally getting dragged towards automation processes. And as you naturally start getting dragged towards automation processes, you will naturally have to start thinking about how you are sampling, auditing, and running those processes. So at this stage, you now have the muscle memory. So from stage 1, you've started to do this in a spreadsheet, or you've done this in like a simple system, whatever it is. You have the muscle memory for what you're doing. You're tracking historic cost basis. You're tracking gain loss. You're getting things into your general ledger. At this point, you now have to understand, like, well, okay, how do I scale that out? How do I make sure I'm testing these things? What do I want to be sampling on a weekly basis, on a monthly basis? Like, what are the processes that really allow me to scale this? And part of that is also then rules. So we're showing a screenshot from Bitwave, but there are 2 sort of sets of rules here that you need to start thinking about. One is system level rules. So whatever it is, it's saying like, hey, we're going to set a rule that any outbound crypto going to address XYZ is always a contractor payment. That means that there's, let's say that means there's at least 2 transactions a month that you don't have to code, maybe even more. You set up rules that say, hey, any inbound transaction hitting our wallet, 1, 2, 3, we're going to book that as revenue. Boom. That's, for some of our customers, that's 20,000 transactions that they don't have to code manually. And so you want to start thinking about rules from your system level around how you build rules to actually manage coding, categorization, all that kind of stuff. You also then need to be building business, like rules for your business. So we already talked about this multiplication of wallets. You're not going to have a lot of luck stopping that. This isn't one of those things where finance puts down their foot and says, no more wallets. Like, that just doesn't really work. In the same way that like IT has a hell of a time telling people not to use, whatever product it is, you will have a hell of a time basically having this sort of tail wagging the dog thing where you are telling people not to use wallets, not to go into protocols, not to do it. Like, it's just, you can do it for some level of time, but at some point you as a finance team gets dragged kicking and screaming into this world. So at this point, like, you need to set up rules for your business. Most of them will be kind of reactive. They'll say, hey, if you're going to go into a new protocol, or like a new DeFi protocol or a new blockchain, you need to tell the finance team, and you need to tell them before you go into that protocol. We're not going to gatekeep you. We're not going to tell you not to do this, but you need to tell us before you do this so that we can start thinking about the processes before they close. Other rules would be, if you create a new wallet, set up a Slack channel that says, like, any new wallet gets created, you dump the address into the Slack channel with what blockchain it's on. Simple stuff. They're not huge issues, but they are there. Or every month, like, other rules could be every month that you basically grab all of the outbound transactions from your wallets. You grab all the addresses, and you send it to the people that do these transactions, and you tell them to identify who these were to, so that you can then set up, you can connect them to contacts and set up coding rules and all that kind of stuff. So there's 2 sets of rules. There are system level rules that you are building to manage the volume of transactions you're going to be getting. That might even include roll-up rules. So, at some point you hit 10, 20, 30,000 transactions a month. Suddenly, QuickBooks doesn't really handle that all that well. You're seeing too much in QuickBooks anyways. You want to start rolling stuff up. So you have system level rules like, how do I categorize something? How do I roll it up? What does all that look like? And then you have organization level rules that says, like, hey, before you go into a new blockchain, you tell me. Before you create a new wallet, you tell finance. Like, the rules that basically dictate how your business kind of runs on this. And then finally, I mean, this is the important part, is like, at this stage, you will really have a lot of trouble doing this by hand. So, not to belabor it, like, Bitwave is one way to do it. You can write scripts. I mean, if you have a finance team that has engineers on it, you can write scripts to pull from CSVs and actually do a lot of this stuff manually. You can write scripts to integrate with pricing services. At this level, you really cannot, you can almost no longer get away with doing this manually. You really need to be doing it automatically. I heard a story once, and I think this is true because I heard it from someone very reputable, that for a big company like, it was like Coca-Cola we were talking about, that might have, 500 or 1,000 bank accounts. They may have one person per bank account doing bookkeeping and rec on just that bank account. And that might actually be most businesses here. I mean, you probably have like one bookkeeper, you probably have one bank account. Those things tend to line up in that way. You can't scale your crypto accounting like that. So you really can't scale your crypto accounting on like one person per wallet. You have to find other ways to scale it. And the only real options there are finding systems. So that's downloading CSVs, having tooling that will go through and annotate those with prices, using systems like Bitwave, whatever it is, like this is where you really have to get serious about the automation here. Even if you build it internally, we won't begrudge you but it's important to start actually doing this stuff in an automated way there. So where you want to get to at the end of this is a couple of things here. So first of all, you want to have the process established. We just spent all this time talking about the processes that you want to do, but basically, like, you want to understand exactly what it is on a monthly basis. You want to understand how you're getting notified of new wallets from the people in your organization, how you are interacting with those people to help with coding. So, in a traditional world, when someone swipes their credit card, their corporate credit card, they use Expensify to tell you as the finance team how they actually spent that money. The crypto world, they don't actually have that. Like Bitwave, we have tooling to help with that. They might just Slack you a transaction every time they do it. You might Slack them and say, hey, I noticed you did this transaction. What was it? But at the end of the day, like you will start to see a disconnect between the people doing the bookkeeping and the people spending the tokens. And you need to make sure that there are open lines of communication between there. And there's a system for how that happens. Like, you don't want to be ad hoc. You want there to be, hey, on the 30th of the month, I will send you a CSV of your wallet and the transactions you did, and you go through and do it. Or, hey, I'll give you access to Bitwave, and you can see just your wallet, and you have to go through and code it, or whatever. There's a lot of different ways to kind of handle this, but you need to have built processes for like getting information between the finance team and the people actually spending the money. You should be down to a 10-day close on crypto. Now, this can be difficult, especially like we talk about the example of you find out on day 7 that there was a new wallet added on a new blockchain, and you're like, well, what do we do now? This can be difficult, but you should be getting to the point where you can close your books in like 1 to 10 days on your crypto assets, depending on the volume. You've selected tooling, whether you're building it yourself or you're using Bitwave. Like you've selected tooling for doing this. You have that tooling running. You're kind of like getting your feet under that, because this is going to scale. I mean, you're going to go over the next, like this phase can last several months to a year, but you're going to go from 100 to 1,000 to 10,000 transactions a month very quickly. And without tooling, it gets very, very difficult. You have widespread crypto knowledge in your organization. You're keeping people up to date with brown bags. So as new blockchains get added and new stuff happens, like NFTs is a good example. So like people that were like really deep into DeFi, you want to go once NFTs become really the new thing, you want to spend a day and go let all of your people buy an NFT and do all that kind of stuff. And then finally, as part of the process documentation, you are now working towards audits. So the process documentation is very important, because it's not just it doesn't just tell you how to do your work. It tells you how you're going to really audit this stuff on the other side. So one of the important process points that we always make is you should be doing some sort of auditing from your general ledger back to the blockchain on a weekly basis. So or a monthly basis. So once a month, someone who did not do the close, someone who did not do the day-to-day bookkeeping, should go in your general ledger, pick a particular crypto transaction, make sure that they can trace that transaction from the GL to your subledger to whatever system you're using for that to the blockchain. Make sure the number looks right on the blockchain. Make sure that the number looks right in your subledger. Go and independently verify the price. So go to CoinMarketCap or Crypto grab a price yourself for that asset. Make sure it is within a few percent of the price that was actually used. Make sure you verify that, and then go back to make sure that it's correctly in the GL. So a few times a month, you're going up and down that whole stack, because that's what your auditors are going to do. Your auditors are going to do sampling, they're going to do testing, they're going to like basically poke all these things. make sure that you are sort of supporting them and that you are testing those processes well before it gets to the audit level. All right, we're going to pause there and open it up to questions. So let's see. I think we got a couple questions here. Do we have any questions? If anyone has any questions, please feel free to throw them in the chat room here. I'll give a couple of seconds here for people to ask any questions they might have. No questions? All right. Well, then we'll keep on rolling on here. We will just keep on talking about this. That's all good. One of the other things. So one of the things I'll talk about very briefly is another framework to think about digital assets a little bit. So this is a little bit more Bitwave centric. So if you're not as interested in Bitwave in general and you want to kind of get onto the other side here, feel free. Feel free to ask questions directly in chat or anything like that. But I'll talk about another framework at this point in time that you should start using is these three bubbles here. So ignore the Bitwave in the middle there, but essentially, like, you as a business are now beginning to pick up obligations. So you as a business are picking up accounting obligations, you're picking up tax obligations, and you're potentially picking up compliance obligations. So one of the things that your Tiger team should be doing, so one of the processes that they should be doing, and this is a pretty normal process that you would see in businesses, which is kind of like a risk assessment process. One of the processes you want to have for your Tiger team on a monthly basis is to kind of evaluate where you sit in terms of obligations from these three different buckets. So between your accounting obligations, your tax obligations, your compliance obligations, where do you sit? A great example of why you want to do this is what just happened with the infrastructure bill is that a lot of our customers' compliance obligations changed. So a lot of our customers were kind of puttering along happily, doing great in this world, no government, the government kind of staying out of all our business. And then some of the infrastructure bill said, hey, you guys are all brokers. You need to start doing 1099s or other type of like reporting that they hadn't done before. This can be kind of scary. And so you as a business need to start thinking about, like, on a regular cadence, monthly, quarterly, whatever it is, you want people in your organization that are basically evaluating whether or not your obligations have drastically changed. For instance, that could include, on the tax side, that could include something like going to a new country. So if you create a subsidiary in a new country, that country might have different laws for cryptocurrencies. So you might have different types of country-specific obligations, tax obligations that you're picking up. On the accounting side, as you grow and as you start to look at going to be a public company, you might need to start you might need to start being GAAP compliant. GAAP versus non-GAAP versus GAAP treatment for digital assets is incredibly different. There is a very, very major burden that GAAP US GAAP companies pick up as part of being US GAAP for digital assets, and that's impairment. So that's this idea that you basically, from an accounting perspective, you might at some point need to write down your digital assets and take a loss, but the same thing does not apply in your tax treatment for those assets. So something you've split and you end up having two sets of books, tax books and accounting books. Very, very, very common with our customers to see that. And so that's a form of, like, at some point you will make the decision that you as a business, you've gone from like small to large, you're about to go public, you're about to get audited, whatever it is, and you need to start being US GAAP compliant, and you need to actually do something to handle that. The other thing would be maybe you went to a country that's IFRS. Well, IFRS has slightly different rules than US GAAP, and so at that point you might need to do you might need to make the assessment that you should change your accounting processes to deal with something else. And of course, like you also want to be looking at like the load. So at some point, the amount of effort you're putting into ARAP gets to the point where it's so burdensome, you really need to bring in software to help with that, or you need to bring in processes and software, or processes and additional headcount to deal with that. So this is a framework that I really like to apply to digital assets, is that you as a business, probably have one of these three, have at least two of these three obligations. You should be evaluating on a very regular cadence where you sit with these obligations, where you will sit, and what you need to be building today. A good example of that is that the infrastructure bill is coming out for is basically going to be active for 2023. So one of basically the way they wrote it is that a lot of the exchanges are required to do 1099-Bs for 2022. Well, one thing to think about is that you don't want to do your first compliance. You don't want to do your first compliance pass under the gun. Like the very, very first time that you ever gather customer data and try to turn that into something that you send to the IRS, you don't want to figure that out December or January of 2023 when this is something, when you're something you get fined a lot of money if you do it wrong. What you want to do is you want to basically do a dry run for 2021, make sure that your processes work, wrinkle out any hiccups, figure out where you're going to need to have new UI, and then have a lot of engineering lead time so that when 2023 rolls around, you're in good shape for it. So, a Tiger team that thinks about like how the infrastructure bill affects your business a year out is incredibly valuable here. And just looking at the world that way is incredibly valuable here also. So I'll leave it there. If you are at all interested in anything you've heard today, bitwave.io/DAMM. Or just click the link at the top there as the digital asset maturity model. It goes into great detail about everything we've talked about here. We have another webinar coming up in a couple of weeks that goes into level 3. Level 3 is the fun level. Level 1 is the scary level. Level 2 is the kind of like the high risk level because you're scaling up your efforts and you have a lot of things, you have a lot of risk. Level 3 is where you have good processes and you can start doing really fun stuff. You can start making money on digital assets. You can start like really cranking on this stuff. We're going to talk a lot about like how do you monetize your crypto holdings? How do you monetize your content? How do you create new revenue streams from crypto? Next week, the next webinar we have, which will be coming up in a few weeks, is going to be really, 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 really fun. I highly encourage everyone to get involved with that. And that's it. So thank you so much, everybody. It was a real joy to get to talk through this. If you have any questions, please feel free to email me. I'm pat.white@bitwave.io, or you can email us at info@bitwave.io. Check out the white paper on the website, bitwave.io/DAMM. And we look forward to seeing everyone next time. So thank you so much, everybody.